I guess this is the advantage of having the WUQ first thing in the morning. Hopefully, it also means that we'll have fewer amount of coffee breaks. Uh, we'll see how it goes. Um, so this is the last class in this module. We're going to be talking about time series forecasting. Okay, um, time series forecasting is a very important class of problems where um, you're forecasting data based on past information. On surface, it might seem like regression. Regression also, we have some past data. We have past better. Um, so in regression also we have past data. We train a model based on the past data, and we try to forecast what might be the appropriate value of the output for a future data. Um, so on surface, it might seem like time series methodology is similar to regression. And to a certain extent, that's true. A lot of what we're going to be doing in time series methodology, time series forecasting, is rely on ideas that we have, rely on concepts that we have already. Let's see if it's better now. Uh, so we'll be relying on a lot of concepts that we have developed in during linear regression and few ideas that we touched upon during logistic regression. Okay. Um, Now, the one thing I do want to point out, however, is that what you will see with time series forecasting is, the way we introduce topics, the set of problems that we talked about during linear regression were all topics which were all problems where we could see why linear regression might be effective. And we looked at the forecast and for the test data set, and the forecasts were pretty decent. What we will see when we start doing time series modeling is anytime we start dealing with some real data, you'll see the limitation of the mathematical techniques that are available to us. What we can do, how much we are actually going to be able to predict, um, is going to be pretty discouraging. But so this is probably a right time to quote, put a quote by Niels Bohr. This is the same guy who did the Bohr's model of atom that you guys probably remember from high school. Prediction is very difficult, especially if it's about the future. Right? Dealing with past data is all very easy. Right? Anytime we talk about future predictions, it's going to be hard. Thank you. Let me try that. So let's start by talking about what is time series data. Okay, time series data is nothing but a sequence of data points that occurred in some particular order. Okay, it's an ordered sequence of data points. The ordering is not done by the size or in increasing or ascending order, but the ordering is based on the order in which that particular data point occurs. Okay, so there are multiple examples of time series data. You might be measuring the population of the country every 10 years. So in 1900, this was the population. In 1910, this was the population. 1920, this was the population, and so on and so forth. So you take the population data and you line it up in the order in which it happens. Okay. Some of the things that are done usually is that the time interval between two of these data points are always same. Okay. So when you're talking about, if you're talking about 10-year data, the time interval between any two data points is 10 years. So this is the data that is arranged in the order in which it happened. So the symbols that we'll be using is going to be like this. YT is the value of Y that happened at time T. Y that happened at the previous instance of time, whether it's a previous 10-year period you're talking about or previous day you're talking about, whatever might be appropriate for that particular data set. And so this is a typical notation for time series. Okay. Why do we want to deal with time series? Why is this any different from the problem of regression? Let's say we want to forecast the next month's stock price of Tata Motors. One might, when we dealt with regression, in order to forecast the future stock price, we need to find out what are the best regressors for it, or best set of features, or best set of predictors for next month's stock price, right? One might start listing the set of factors that you might need to make good prediction for the Tata Motors stock price as follows. So you might start by saying, the next month's stock price, in order to know what the next month's stock price is, obviously the current month's stock price matters, right? The current value of sales, revenue, and profit data might matter, right? So if you call this as predictor as X1, the sales trend, is the trend on the increasing line, or is the trend decreasing? The number of cars, is it increasing or decreasing? That might be another predictor. The level of debt carried by the company. Obviously, the stock price is going to depend on how much debt the company actually has, right? So the level of debt carried by the company might be a good determinant for the future stock price. Competition, if there is a way we can convert the size of the competition into one number, that might be a useful predictor for determining the stock price for next month. Import-export rules. Obviously, we are Tata Motors. The import-export rules are going to impact the stock price of Tata Motors. Why? Raw materials will be importing, plus good portion of sales actually happens outside the country as well. So Tata exports cars to Sri Lanka, Bangladesh, Pakistan, variety of other neighboring of Asian countries. It sends its cars. So obviously the import-export rules is going to impact its profitability, and hence it's going to impact the stock price. Interest rate environment, right? Why might this matter? The level of debt carried by the company. The company needs to pay interest on the debt it carries, so the interest rate level matters. Why else might it matter? If the interest rates are high, people might be reluctant to take a car loan, right? So the sales might be impacted depending on what the interest rate environment is. So interest rate environment might be impacting the stock price. How about this? The US exchange rate, US dollar exchange rate. That's going to impact clearly because we are importing stuff and we pay for it in dollars, right? So that's going to matter. Tax rates. Tax rates is also going to determine. And this is like a huge bunch of things that we can list that are going to be potentially determining the stock price in the future. Black money. We do know that good portion of the Indian economy is driven through cash transactions. Any government actions on cash transactions is going to impact the number of sales, right? Cost of steel, how about this? Number of smartphones sold. Do you think that's going to impact? Likely, is there a reason why that might be a predictor? Correct. Basically, this number of smartphones is a reasonable indicator of amount of disposable income people have. And when people have disposable income, they are more willing to buy your second car. So the car sales are actually impacted by many of these factors. The thing is, we talked about these factors in the past, just 2 minutes, right? 2 minutes of thinking. You sit down and discuss more, I'm sure you're going to come up with 50 other variables that are going to be potentially impacting the price of the stock price of Tata Motors. Now, if in just 2 minutes of thinking we got 11 predictors, right? Half an hour thinking, we'll probably get another 40, 50 predictors. So in order to make a good forecast of price of Tata Motors, we'd be requiring 50 different predictors, and we need to collect data for that, fit a regression for it, and make forecasts on what the price is going to be, right? And let's say you want to make forecasts of price 2 months from now. You need to estimate all of these 50 predictors for the next month as well, so that you can forecast it for the following month, right? That's a pretty arduous task, right? Is there an easy method to do it? That's where time series forecasting comes. What time series forecasting says is the following. Your normal forecast is based on the following idea, that your forecast of at time t+1 is dependent on, could be a nonlinear function of the time and some n different features in addition to the past stock prices. Okay, the past trend in stock prices. In addition to that, n different features are needed to make forecast for the next month's stock price, right? The idea of time series forecasting is, can we try to do the same forecast without using any of the predictors? Without using any of the predictors, can we look at only the past data and make a forecast on how the future price is going to turn out? Okay. Why might this be possible? This might be possible because the stock price in this month's stock price potentially has all the information that we talked about. The interest rate environment, the trend of car sales, the import-export rules, all of that information is encoded in this price as well. It was encoded in the previous price, and so it was encoded in the price before. So using just this, is it possible to make a good forecast of the data in the future? That's our motivation of trying to see if we can use time series data to forecast. So the goal is not to study what is the impact of interest rate environment on the future stock price. That's not the goal. The goal is just forecast the future stock price. Very good point. All I'm trying to see is, can I make this forecast? Each one of these variables has all of this information encoded in it, right? Some small percentage, right? Can I just look at the trends in this data to make forecasts on the future without knowing the underlying macroeconomic features that are causing that particular move, right? That's the attempt. We don't know how successful you are going to be, but it's a worthwhile attempt, because if you really need all of the data to make each forecast, it's going to be painfully arduous task, right? So this is more a practical thing to do. Let's see how much progress we can make. And this kind of attitude is with which we approach linear regression as well. When we talked about trying to model stopping distance of the car, looking at just the speed, we knew there were other factors that were involved. We knew that the weight of the car was involved. We knew the quality of the tires was involved. the nature of the braking system was involved. Whole bunch of other factors were involved. But we decided to see how much of the forecast can I do with just one of the variable, which is speed, right? So it's not saying that this is going to have complete information and it's going to be doing perfect forecast. That's not at all the claim. The claim is using this limited information, what can I do? What level of accuracies can I achieve? And when is this actually going to be possible? When will this not be possible? Okay, all of those things is what we're going to do in time series forecasting. Okay, is the motivation clear? So exactly. What we listed are known variables, right? There are also other variables which we would call as known unknowns, right? There are variables that we know potentially impacts it, but we don't know how to measure it. Okay, and of course we are not even we are talking about the unknown unknowns. Clearly, there are some other variables which are going to be impacting, which we don't know about, and since we don't know about, we don't know how to measure it either, right? So let's see how much progress we can make with just this. That's our current focus in this particular lecture. Okay. Um, so why time series again? Because many of the causal independent variables are unknown to us, or they might not be available to us, and sometimes even when they're available to us, it's hard to forecast based on that. An example might be of if you look at the stock price on a day-to-day basis, on an intraday basis, the price of the stock varies minute to minute. All the factors that we listed, right? The tax rates and interest rate environment and all of that, those factors do not change on a minute to minute basis. And still, the stock price actually changes minute to minute basis, right? So it's hard to correlate between what's happening with the fundamental set of data and what's happening with reality. So what we are choosing to do is, let's forget about all the features. Let's see what we can do looking at just the variations in the stock price. Looking at the past information on the stock price, can I make a reasonable forecast for the future without using any other predictors? Okay, so we're going to be doing this in multiple, we're going to talk about multiple approaches of doing this. The first approach we are going to be talking about is through trend analysis, right? Forecasting through trend. Trend analysis obviously is can be applied only in some situations, and we should be careful about what are the situations you apply it to, as that cartoon indicates. Just because you had 0 husbands yesterday and today you have 1 husband does not necessarily mean you have a couple of dozen husbands in a month. My it's a nice pun, yeah. So what are we going to do in trend analysis? What we are going to do in trend analysis is further simplify the problem. Okay, we are going to try and forecast the next data only as a function of price. Okay, so we are simplifying the problem even more. So let's start with an example. Well, this kind of regression can be this kind of forecasting would be called as regression on time. Essentially, what we will be doing is simple linear regression with the independent variable being time. That's what we are going to be doing. Right? It's a complex way of representing this. Independent variable is time, and we are trying to forecast y. Right? Simple linear regression. So this is applicable when the trend is most pronounced in the data. Let's talk about this. I have sales data of some fictional company. What I'm representing here is sales in thousands of dollars, and on the x-axis is the sales value in different quarters. Okay, so this is actually very typical of how your data is going to look. The data is not going to look nice, smooth straight line or even a nice smooth curve, but the data is going to look pretty choppy. Do you see any patterns here? Overall, sales are increasing, right? That's the big picture pattern that we see, right? So one might try to do a linear fit. Is this a good fit? Well, first is we know how to do this linear fit, right? Simple linear regression. Independent variable is time, dependent variable is y. Just use lm to do this particular fit. Okay, it's not a terrible fit, but there are some important things that it's missing out. Some important uh, uh, patterns it's missing out. One thing it's missing out is do you notice that the errors, I should have drawn the residual plot, I haven't done that. But do you see that the size of the errors here are small and over here are large? What might that indicate to you? Heteroscedasticity. So what should you be doing? Some nonlinear transformation, right? What might be a nonlinear fit that would be appropriate here? Quadratic. Let's try a quadratic fit. Let's see how that does. Better? It is definitely an improvement over the previous one, right? You do see that the size of the errors here are reasonably okay. But it's still missing one very important feature in the data. Correct. So what we do see is this is the first quarter, second quarter of the year, right? The second quarter is actually lower. Third, fourth quarter. Next year, first quarter, second quarter it's down. Third, fourth it's going. Again, first quarter, second quarter. The second quarter of every year, the data is actually dropping. Why might that happen? Sorry? Tax returns might be a good this thing. You know, there are some quarters when the sales are higher naturally, and there are some quarters when the sales are lower. If it's the US market that one is talking about, the sales are typically high on the first quarter. On the last quarter. Of course, last quarter of the way the fiscal year is defined in the US, which is around the Christmas day. The way first quarter, second quarter, third quarter is defined in India, it's all shifted based on the Indian financial year, right? But in the US, you know, all the big festivals, you know, Christmas, Thanksgiving, they all happen in the last quarter of the year. During those quarters, the sales actually are very high. And since all the sales happen in that time, the subsequent quarter, the first quarter, the sales are actually lower, right? Because people have spent extra amount of money during that particular quarter, and the subsequent quarter is lower. Now, the kind of fit that we did completely ignores that particular pattern there, right? That pattern is actually very useful information. And yet, the fits that we have talked about do not provide a way to capture that at all, right? There's no way to capture that thing. Or is there? It's based on quarter to quarter, right? So perhaps quarter itself is the quarter number itself is a useful predictor. You remember in the bike demand problem, we used the hour value as an important predictor. That is an important categorical predictor, right? Over here, we can do the same thing. We can add the quarter number as an important predictor, right? How would you do that? There are 4 quarters. All I need to do is add 3 dummy variables, right? You could do it less, I admit, but at least 3 dummy variables, we can do that fit, right? So quarter 1 you would represent as this. So what do we have here? What we have here is a fit with linear and time variables plus a quadratic t squared term, quadratic in time, because we decided quadratic fit looks better. In addition, we are going to have 3 dummy variables that represents which quarter we are talking about. Okay, we are still using the linear modeling formula. LM is all we are going to be using. Let's see how well the fit does. Do you think the fit should be better? Let's see how better it is. How about that? Does it look like it's a linear model? Does it make sense it's doing this? Sorry? It provides a formula, why not? But does it intuitively, do you have an intuition about why it's doing this? I mean, this should not, a linear model should not be able to do this kind of complicated fit, right? Correct. It is a linear model, but it's linear for each quarter separately. So if I plot it quarter by quarter, what's actually happening is it's doing separate quadratic fit for each quarter, and depending on which quarter you're talking about, it just changes the value of intercept. Okay, that's what is happening, right? Who would have thought that LM could allow us to do all kinds of things, right? And this is just LM that's allowing you to do. So we can explain seasonal variations in sales by adding the quarter number as a potential deterministic, as a feature, and that feature will allow us to explain seasonal variations. Is it clear what we are doing here? Yeah. Let's take a larger data set, and let's see if we can do the same thing with that. Okay, larger, more complex data set than the simple fictional sales model. So this data set is a data set of number of births in New York City from 1946 to 1959. Okay, monthly data of births in from 1946 to 1959, and when I plot that data, it looks like this. Okay. Now, I don't know about you guys. My expectation was that when you see population growth, do you see any oscillations in population growth charts that you have seen? About how India's population is increasing. You don't see any oscillation. It's just increasing, right? I don't know if we have, in the past 5 decades, whether we have ever seen a decrease at all. It's always been on an increasing thing. So one would expect, when you look at the birth charts should also show a uniform trend. Whereas what you see here on the birth chart, this is not the astrological birth chart. This is a birth count chart. You see these ups and downs, right? When we talked about sales, those ups and downs were easy to understand. We had a potential logical reason for why some quarters might have lower sales and why some other quarters might have higher sales. Is there a logical reason why births should show this kind of pattern? I mean, do babies prefer being born in some months and not some other months? If you remember, I asked a similar question about the week of the day. We talked about, do babies have a preference to be born on Saturday versus middle of the this thing, and we found in that instance the weekend births were actually higher. No, lower. Sorry, weekday births were higher. Um, Here, is there a logical reason why that might be a case? If you look at the data, right, the number of births have a dip in February. Forget about the exact month where it happened. Can you think of an explanation as to why births in might have some pattern based on the month? Sorry? Number of days is a good explanation. February has smaller number of days, and so perhaps it's going to have slightly lower number of births. Okay, so what about the peaks then? So would you be surprised if I tell you that the same kind of patterns exist in India as well, although from different set of months? Right. So in India, we all know, right? Marriages happen through, the auspicious season. So obviously, like clockwork, 9 months immediately after that, to the day there's a child born, right? That's very typical this thing. So if you understand the reasoning behind when marriages happen in particular seasons, you would expect the births should have a phase shifted number, but should have the same kind of seasonality, right? And that kind of logic is the same reason why you see this here. It corresponds to the vacation time. People go on summer vacations, and then that results in babies in around February thing. So there is a reason, right, why this happens. But what we are trying to do is, can we use these techniques that we learn of regression, of an trend analysis, by and incorporating seasonality into the trend analysis, can we make forecasts? Right? That's what we are trying to do. So let me quickly pull up that data set and just show you one example. Now I've sent you this R file, right? You should be able to play with this on your side as well. So yeah, let me just show you what I'm doing. I'm downloading the birth data from a website, and I'm this particular function converts this birth data. The birth data is just given as a set of numbers. Okay, this one I'm converting it to a time series object. All the time series object does is it puts a label to that particular data set. Okay, so I'm saying this is a raw data of births. If you look at this data, it's going to look like a string of numbers, right? And I'm saying this is actually a time series object with a frequency of 12. I'm explicitly saying it's a monthly data. So there is some calendar frequency of 12, right? If I had daily data, I would have given frequency of 365. Okay. So the frequency, I'm telling you how many data make up a year, a season. If it was a quarter data, I would have put frequency is 4. Okay. And then I give a starting date. The starting date is 1946, first month, January. Okay. And then it puts the data in a time series format. Birth time series. If I do that, that looks like, so it looks like this. Okay, it nicely aligns it in a calendar and assigns correct dates to rest of the data. What I'm going to do now is try to fit this data with a linear model. again. So I'm trying to do a linear fit, the birth as a function of time, LM. I'm also doing birth as a function of quadratic in time, Pauli, birth, order 2. Okay, so quadratic in time. And I'm also going to try to do a best fit with cubic order in time. Okay, let's see how each one of those fits look like. So that's a linear fit, quadratic fit, and that's a cubic fit. Okay, obviously this kind of fits does not take into account the seasonal variations, right? So how do I create seasonal variation? Add a dummy variable. Dummy variable, all Januaries I'm going to mark it as 1, Februaries I'm going to mark it as 2, 3, so on, and declare that as a factor, right? And that's what I'm going to do here. So this particular line of code does that. Okay, it's adding 1 to 12 for 14 years, right? That's what it's doing. When I just keep disappearing. When I look at the data, what it has done is I have the birth number and I've added an extra column which which is the different seasonalities, 1, 2, 3 to 12, 1, 2, 3 all the way to 12, 1, 2, 3 all the way to 12. Okay, and now I take this, declare this as a factor, and try to do a linear fit, quadratic fit, and cubic fit. Wait, I didn't run the code which creates factors. Do that and then. And let me plot this. And look at that. Linear and quadratic fit. You can see that it explains the seasonality pretty darn well. Okay. Nothing complicated than linear model, LM being used. All we have done is added one seasonal variable and it's able to explain the seasonality in that complicated looking time series. Yeah. We can do the same things as trying to measure the quality of fit by, root mean square error or any of those other metrics that we talked about. Is the idea clear? What I'm doing, the methodology? Yeah. Yeah. How do you know what degree is this thing? So, as always, simpler models are better, right? So, you would try to determine what is the right model, right level of complexity use based on some metric which penalizes complexity. Do you know of any metric that penalizes complexity? Adjusted R squared would be a reasonable one, or AIC. So AIC is more commonly used. So AIC also penalizes the addition of new variables. So and I would encourage you to start using AIC more, even though it doesn't give this nice physical thing, because the AIC formalism applies for all of these things that we have talked about. It applies for regression, logistic regression, or any of these classification problems, and also for time series modeling. So AIC is one metric that applies all across. So it's useful to start getting familiar with that particular metric. Okay, so this is the linear and quadratic fit, and over here is the cubic fit, which actually the cubic fit turns out to be really good because it captures this particular variation in that data as well, right? Any guesses as to why this drop is there here? Correct. World War II. The drop in births happened during the World War II, and subsequently after World War II, the births increased pretty dramatically, all the way up to the data ends at the beginning of 60s, all the way up to mid 60s, the birth increased, and that particular generation who were born post World War II up to 60s are called as the baby boomer generation, and lot of economic policy is decided based on that baby boomer generation, because that generation is retiring now, which means the government needs to fund for their healthcare, they need to provide pension for them, and all sorts of things are determined based on that particular segment of people who are born in those 2 decades. And after those, the birth rates drop. So is this method of incorporating seasonality clear? There's one more method of incorporating seasonality, which is often used in businesses. Okay, businesses find this complicated to think about. They like to work on Excel sheets, and the way they account for seasonality, if any of you have done MBA or any MBA equivalent course, you might have seen the next method of incorporating seasonality in your classes. Okay. What we are going to do is this. Let's say we have a data, again, quarter by quarter data for some companies. So I have, just to make things simple, I'm going to talk only about 2 years. So 8 quarters. Okay. And I have revenues for this particular company for 2 quarters, 2 years or 8 quarters. Okay. And there is, it starts at 10, increases to 15, again it drops to 11, then again increases. So it's got that seasonal variations that we talked about. So the way businesses adjust for seasonality in the data is they take this data and run a simple linear regression directly on that. Okay. So they take all of the data points, just do a simple linear fit. Is the model significant? Coefficient significant? What's the equation of the line? (944x), which is actually quarter number in this case, right? So that's the regression equation. What they do is, once they have done the fit, they list out the predicted values by the regression. Okay. Here are the actual values by regression, and here is the predicted value by the regression. Obviously, the predicted value by regression will not account for seasonality, right? It's a simple fit. What they do is they compute the factor by which they got this number wrong. So the factor by which they got this number wrong is, so this predicted value, the 10.2 is the actual value. This is the predicted value. They take the ratio of that. So it was off by 0.92, right? By that factor. Or predicted value was 0.9, actual number was 0.92 times predicted value. Okay. This, in a sense, captures your seasonality, right? This is the amount by which you got off in each season. And if you see, right, for the first quarter, the numbers are lower than 1. For the subsequent quarters, the numbers are higher than 1. The effect of seasonality can be seen by this seasonal adjustment factor. What they do is they take all the first quarter values, adjustment factor, and take an average of it, and give you an average adjustment for first quarter. This is the average adjustment for the second quarter. average adjustment for third quarter, average adjustment for fourth quarter. So they compute average adjustment factors for each quarter. If you want to now make prediction, the data is given for 8 quarters. If you want to make a prediction for the 9th quarter, all they do is you have the equation of the line. You check what the line will predict for the 9th quarter. Then use the first quarter adjustment onto that to get the actual value, to get the true predicted value. So for the 9th quarter, they get the prediction by the pure trend line, which turns out to be 18.53. But then they correct it for seasonality by this number, this average adjustment factor that they got, to get the seasonally adjusted value for the 9th quarter. Okay, this is what businesses do. And so when you talk about, when you hear economic news about, the GDP for past quarter was this particular number, and they'll also say it's seasonally adjusted value of GDP for that quarter. What they are doing is this adjustment factor that they are multiplying from that straight line that they have created. Okay, so this is the way seasonal adjustment is done in most of the financial sectors. Is the idea clear? So what you're saying is correct. So this one, in a sense, takes care of it. If the idea is this, you are still fitting for the overall trend a straight line. As long as the overall trend of straight line is correct, this adjustment takes into account the fact that as numbers grow larger and larger, they should be accounted for by a factor. This kind of seasonal adjustment that we have done is different than the previous seasonal adjustment we did. What did the previous seasonal adjustment do? It fitted straight line or quadratic line for each single quarter separately and adjusted the quarter by a fixed value of intercept. So quarter to quarter adjustment was done by a constant number. Over here, the quarter to quarter adjustment is done by a factor. Okay, because as revenues grow, the amount by which it might drop for the quarter changes by a factor, not by a fixed amount. This kind of seasonal adjustment is called as multiplicative seasonal adjustment. The previous adjustment we talked about was called as additive seasonal adjustment. So there are two kinds of seasonal adjustment one can do, multiplicative or additive. This is a multiplicative seasonal adjustment. Whatever is obtained by the straight line, you are adjusting it by a factor to account for the fact that in that season it will drop by a factor rather than by a fixed amount. Right. Right. Correct. Exactly. Right. So that detail, I mean, you said it perfectly. We will get there in a few slides. We're going to talk about moving average, moving window averages, and so on and so forth. But the idea is, as long as the assumption that the overall trend is linear is okay, this kind of adjustment is okay. It might turn out that the overall trend being straight line is wrong because suddenly you are hit by recession and suddenly the sales start dropping quarter after quarter. That is possible. But in that case, what was wrong was not the seasonal adjustment factor. What was wrong was the overall trend line was wrong. Right? But given that the trend line is okay, reasonable for the model, the seasonal adjustment is done this way. Yeah. Whether multiplicative or additive, which is a better model. We'll come there. We'll also talk about how you identify whether which is appropriate given what situation. So in this case, so I for the same uh, the birth count series, not the birth chart, birth count series. If you do the fit, linear fit, and do the adjustment or using multiplicative, that's the way it looks. I could have done an additive series adjustment, and that's the way it looks. Can you tell me which is better? Obviously, I'm shifting it so that you can compare. I'm relying on your short-term memory. It looks like it's hard to say which one is appropriate. Thing is, like everything that we have done, the answer is it depends on the series. Okay, let us. This is a complicated series, and it's the only way to find out whether which one works better is to actually compute your root mean square numbers, root mean square error numbers, and find out which one was better. But none of both of them are decent enough in this particular case. Um, but some data sets, you'll be able to clearly see which one is appropriate. The way you identify it is the following. If you see that the variation between your peak and trough, right, your high sale point, your high sale quarter number to a low sale quarter number, that about remains constant. Okay, that means you have a case of additive seasonality. That would imply that you can fit one line for the top one, another line for the bottom one, and both will be off only by a fixed constant. Whereas when the size of your oscillations increases, that's a clear-cut case for multiplicative seasonality. Okay. Most real-life series, when they are plotted for fairly long time, where the trend persists for a long time, long enough that the magnitude changes by an order of magnitude, then multiplicative seasonality is what you will normally observe. Okay, when revenue increases by a factor of 10 over a decade, right? The fluctuations quarter to quarter is going to be off by percentage of that revenue, not by a fixed 1 lakh number, right? Those fluctuations is going to depend on the size of the value. So most cases, real life situations, where the size of the data actually changes by an order of magnitude, you would see that multiplicative seasonality is a better model. Okay, but if the size of the data doesn't change much, additive seasonality might also do fine, might do just fine. Or if you're talking about time frames which are small enough that the size of the revenue doesn't change that much, additive seasonality works just fine. Okay, and in all of these problems, the way you measure goodness of fit still remains the same. You know, all of those things that we talked about, mean square errors, mean absolute error, root mean square error, mean absolute percentage error, any of them is a reasonable metric for measuring the quality of fit. Okay. So the main issues of doing this method of forecasting time series is that it works only when the trend is actually very strong. Okay, and this is actually too much of curve fitting for a statistician to be satisfied with that particular number. It's got big uses in the business sector. We want to keep models simple in the business sector, so the models that we talked about you will see being used a lot in business sector. Okay, let's see in the next set of slides if there are better models to describe to do time series forecasting. Okay, why don't we take a quick break and then we'll continue. let's just get started. People slowly walk in. So the first set of methods that we talked about was just using trend analysis, where I am trying to fit y as a function of time only. Okay. The second set of method that we are going to be talking about is the other part. So why the forecast of your future value, I'm going to try and do based only as a set of past values. Okay, just as a function of past values, no time at all involved. Can I just use the past sequence of values to make forecasts of the future? That's what we are going to try and do. Okay. Now, for this, we are going to require some tools for this analysis. We are going to see that, any time series can be thought of as having three components. A time series as having trend component. This is something that we talked about already, right? Trend is this, the sales are constantly increasing or constantly decreasing, or the trend part could actually have increasing for most of the time, and after some point it's decreasing because a recession started or whatever. This is the broad long-term based trend, right? Long-term based pattern. That would be the trend component of the time series. In addition, we have already talked about seasonal component of the time series, the quarter-to-quarter variation or month-to-month variation that is there in the time series, which is imposed on the top of the trend, right? The third part, which we haven't talked about explicitly, is this error, which is probably random variation or variations that cannot be easily explained by the simple view of the world of trend and season, right? When we did the fit of the birth time series with the trend part and seasonal adjustment, it didn't fit exactly. There were some errors remain. So we think of that as the random stationary errors. So the paradigm we are introducing is, we are looking at time series as being comprised of three components: trend component, seasonality component, and a random stationary error part. Okay, and we talked about the first method might be appropriate when the trend component is very strong. That is when the first method that we talked about, or the first two methods we talked about, might be appropriate, right? But is there a automated way through which we can look at the time series and tell whether the trend component is strong, or is the seasonal component very strong, or is the random component very strong? That's what we are going to talk about in the next few slides. Looking for a tool, looking for a technique, a mathematical technique, which will identify the strength of the trend component or seasonality component, right? So even though I didn't explicitly define what I mean by trend and seasonality, I just relied on our understanding of our day-to-day language. Here is a chart where I'm showing all of those components explicitly. What I mean by trend is this long-term time interval pattern. Okay, so this was actually taken out from a stock series. The prices were going up, the trend part was like going up on a long-term basis, and then the housing crisis hit and the prices started dropping. But this was not, what I'm plotting here is not the actual stock price. I'm just plotting the trend part of that. And in addition, there were seasonal variations in that prices, right? There was also a noise on the top of it. So all of these three components together is what made up the time series that we see, right? What we have done here is we have split up those three parts. Okay? We'll talk about how to do this in a bit, right? But we are just recognizing that this is one way to look at the time series.